All right, today we're going to tackle a topic that gets a really, really bad rap. Options. Now, you've probably heard of them, and I'm guessing you're thinking they're just risky, complicated, basically financial dynamite, right? Well, what if I told you that's not the whole story? Not even close. Okay, let's dive right in. So, on the one hand, you've got the popular image of options. You know, this nervous cat sweating bullets at a poker table, just pushing all its chips in. Pure speculation. But look at the right side. That is how the pros see them. A confident cat, hard hat on, blueprints in paw, ready to build something with absolute precision. For them, options aren't gambling at all. They're sophisticated engineering tools. So, in this explainer, that's exactly what we're going to do. We're going to dismantle that whole gambling myth, piece by piece. We're going to shift our perspective entirely, from making random bets to designing careful blueprints. You're going to see exactly how options are used to precisely manage and shape financial risk. And what's so cool is what this engineering actually looks like in practice. See, pros aren't just making simple one-way bets. No way. They're using options to build these incredible financial structures. Think of it like a shield to protect their investments, or a little machine to generate steady income. They even use them to trade on market chaos itself, without even caring which way things move. These are carefully built strategies, not just wild guesses. So you might be wondering, how is that even possible? How can one tool do so many different things? Well, it all boils down to one single beautiful idea. It's the absolute core of what an option is, and it's this: having a choice, a power, not a requirement. So first up, we've got the call option. This gives you the right, but, and this is key, not the obligation to buy something at a price you both agreed on beforehand. Just think of our financial feline here. He pays a tiny fee today to lock in the price on that can of delicious premium tuna. Now, if the price of tuna skyrockets next week, our cat can use its option and buy it at the old cheap price. What a deal. But if the price drops, he just lets the option expire. No harm, no foul. He's not forced to buy overpriced fish. And on the flip side, you have the put option. This is the right to sell. So imagine our cat buys a brand new squeaky toy, but he also buys a little put option to go with it. If he gets that toy home and he just hates the squeak, it's just the worst, well, that put option gives him the right to return it for a full refund, no questions asked. It's basically insurance against a bad purchase. And this brings us to a really crucial point, this powerful concept of asymmetry. You see, with most investments, your potential loss can be, well, huge. But with options, the absolute most you can ever lose is that small fee you paid for the option in the first place. That's it. Your risk is capped. But your potential gain? Oh man, if that tuna price goes to the moon, your profit could be massive. And that is the secret sauce. And that is precisely why the pros don't call them bets. They call them controlled risk tools. Because, well, that's exactly what they are. You get to define your maximum risk right from the get-go. Okay. So if options are so great, how do we know what they're actually worth? How do we figure out the right fee for that tuna option? Well, let's build our very first super simple pricing machine. To get our heads around this, let's switch from cats to dogs for a minute. Imagine a stock price is like this happy dog's favorite ball. And right now, it's worth $100. In the future, we're going to say only two things can happen. There's the up future, the dog leaps, catches it perfectly, yay, and the ball's value goes up to 110. Or there's the down future. The poor dog trips, the ball rolls away, and its value drops to 90. This simple up or down map of the future, that's called a binomial tree. Now, let's put some numbers on that. The stock starts at 100, it can go up to 110 or down to 90. So, what's the call option to buy at 100 worth in those futures? Well, in the up future, if the stock is at 110, our right to buy at 100 is worth $10. Simple. In the down future, if the stock is at 90, our right to buy at 100 is worthless, so it's worth $0. Boom! We now know exactly what that option is worth in every single possible future. And this leads us to one of the most powerful and, frankly, one of the weirdest ideas in all of finance. We can figure out the price of that option today without ever having to predict whether the dog is actually going to catch the ball or trip. How on earth is that possible? Well, instead of trying to guess the real probability, which, let's be honest, is impossible, these models create a kind of perfect world probability. It's a purely mathematical trick that basically says, in a world where there are no free lunches, what would the odds have to be to make this option's price totally fair relative to the stock? It's not a prediction, it's just a tool for making the price consistent and logical. Think of it like this. All these fancy models are really doing is just figuring out an option's expected future payoff, and then working backwards to see what that future money is worth today. I mean, if you knew for a fact you were getting exactly $10 in 1 year, and the bank was paying 5% interest, that future $10 would be worth $9.52 today. Option pricing is just a much more complex version of that simple idea. So, if our little doggy adventure is a simple pricing machine, what happens when we upgrade to the ultimate pricing machine? Let's meet the famous, and I promise, much less scary than it sounds, Black-Scholes model. Look, you do not need to know the formula. I don't even have it memorized. Here's the secret to understanding it. Black-Scholes is really just our binomial tree, our dog's adventure, but with the steps getting smaller and smaller and faster, until they're infinitely tiny and totally smooth. It's the exact same core idea, just taken to its logical, continuous conclusion. That's all it is. And here's the best part. This incredibly powerful model only needs 5 ingredients. That's it. You've got the stock price, the strike price, the time left till it expires, the interest rate, and this last one, sigma, which is just a fancy word for volatility. And you can just think of volatility as the market's zoomy level. You know, is the market a sleepy old dog napping in the sun, or is it a hyperactive puppy chasing its tail in circles? That's volatility. And this is so important, look at what's not in the recipe. There are no analyst opinions, no earnings reports, no forecasts about whether the stock's going to go up or down, and there are definitely no good feelings about the market. This is a machine that runs on pure math, not on opinions. And that really brings us to this essential idea. The model couldn't care less about what you believe will happen. It only cares about the range of what could happen. It literally puts a price on uncertainty itself. So let's bring this all home. How does this actually change the way we look at markets? Well, it's about learning to think like a professional. It's about pricing risk instead of just trying to guess the direction. And as the pros are building these strategies, they have different tools in their toolkit, right? For instance, European options are kind of like a fixed appointment. You can only use them on one specific day. American options, on the other hand, are more like a flexible window of time. You can use them whenever you want before they expire. They're just different tools for different jobs. And all of this leads to our final big idea. When you start to see markets through the lens of options, you realize something fundamental. They are not casinos based on luck. They are massive, complex probability engines, constantly calculating and pricing the uncertainty of the future. So what's the real purpose of options? It's not to gamble. It's to take the chaotic, messy randomness of the future and turn it into something we can actually understand and put a price on. It's about letting those financial engineers build custom tools and letting people who want to avoid risk safely transfer it to those who are willing to take it on. Which leaves us with just one final thought. Remember, we started with that nervous cat gambling at a poker table. We're ending with the blueprints for a complex engineering project. The market is laying out all the probabilities right there for you to see. The only question left is, now that you can see them, what are you going to build?